Welcome to TheoTrade. This is Don Kaufman. It's March 26, 2018. You are watching the Theo Night video. Let's get started with the obvious. A ripping explosion to the upside inside of the S&Ps and really inside of the Nasdaq, specifically the Nasdaq rebounding 3.35%. Now, the big question I'm sure everybody has in their mind, was that it? Did we just see the end of some sell-side activity, or ultimately is there more to come? So we're going to look at the S&P futures. I'm actually going to give you a number of key levels inside of the S&P futures. We'll also look a bit at the Nasdaq futures. We will go and we'll take a detailed look at volatility and volatility futures. Are they in contango? Are they in backwardation? We're also going to look at something that people do not necessarily have on their radar screen, and that happens to be the bonds. Why do we care about the bonds this week? I'll tell you why we care, because there's 3 trading days left this week, and there are $294 billion of bonds, brand new issue to be auctioned off. That is the largest number ever recorded in bond history inside of a week. $294 billion of bonds. And last but not least, we're going to look at the idea. Should we step up and short this rally back? All right, let's get started here with the S&P futures. Specifically in the S&P futures, we now have definitively 4 levels in play. Again, 4 levels in play. Let me show you exactly what these levels are. Let me close up this left side bars. There's about 2 minutes left in the trading day. Listen, we're not missing much over here. If you weren't in it, S&Ps are up some 65 points. Now, I'll close up that left side bar and I want to kind of get started here. We're looking at just at a 9-month daily. So what are some of the levels that happen to be on the screen? Well, first and foremost, let's start from bottom up over here. This is 25.75, and this is where we saw the bounce back again. If you look all the way back into February time frame, these were some of the lows that we're seeing in the screen, but 25.75 represented a key inflection point inside of the S&Ps prior to that bounce. Next on your screen, and most recently added, happened to be a level of 26.26. Okay, and I'll kind of zoom in specifically to this level because again, I just added it over the weekend. Now, a lot of people ask about the levels that I may put on my chart. And the levels that I'm placing on these charts, I want to be very, very clear about something. These are not, considered and should not be construed as support and resistance. I'm not here to tell you, oh, this is support and resistance. The levels that I am drawing on here are created, ultimately by mass amounts of risk, kind of correlating to one specific level inside of the S&Ps. And as we trade and over time, and I'll actually show you exactly how I do this, but as we trade, and over large periods of time, when we continue to cross back and forth through these levels, we will see explosions of volume at given levels. And the explosion of volume, specific to the S&P futures at those levels, is indicative of very large trading firms having risk at those levels. And as we trade off of those levels, and again, if you take a detailed look here we are ultimately at 26.26. As we trade off these levels, volume has tendency to explode in an upward trajectory. There's the closing bell. So you can see volume taking off from these particular levels. Now, this level here at 26.26 isn't, necessarily the absolute end all be all, Another level that we talked extensively about, again, a few weeks ago was 25.75. However, we have a really key level in place. The next level up is 26.82. So I want to reiterate my stance over here. I don't want you to think of these levels per se as support and resistance. You almost have to look at the levels, as being like gravity, and that is the market ultimately being pulled right directly to the level. And you'll see we have entire trading days where we're actually just kind of chatter along the levels before ultimately breaking free of one and heading towards, another level up here. In this particular case, right now, we're almost dead smack between levels. And again, I want to kind of clarify what these levels are, because this is critically important, especially for those of you that are trading on an intraday level or just kind of getting a feel for risk. If those of you also recall, It was last week that I talked specifically about, well, the level I'm about to discuss right now. And the level I'm about to discuss right here, right now, happens to be 2682. And that 2682 level, I had cautioned everybody if we were going to sell off, which we did last week, we were going to sell off, we were actually going to stop cold at 2682 before proceeding back down in the marketplace, and we did exactly that. Well, again, think of these as kind of a concentric level. Think of it again as kind of gravity in the market being pulled, okay, to one level or the other. One of the reasons that I like to denote these levels on the screen is that, you know, the marketplace is not likely to just rally right back up through it and just take off. Okay, if we're going to rally back up, which it, again, absolutely could happen as the week progresses. If we're to rally back up, we're very likely to kind of stop there. Now, if somebody happened to be in a short position, okay, you've got yourself an exit. Listen, the door is there, right? You know, we hit 2682. Okay, once we got back to that level, it doesn't necessarily per se mean we're going to go higher. But if we start to actually lift off this 2682 level, I mean, come on. We stopped cold at this level. It gave you time to exit. I mean, hey, exit stage left if you were willing to do so. Or again, at these kind of concentric levels, we could actually pivot and head right back down from that. So again, to kind of denote three levels that are heavily in play right now, down below here, okay, down below, we're looking at about 2575. All right, dead center in your screen here, we're looking at 26, okay, 26, and the upper level on your screen again happens to be 2682. All three of these levels are clearly and decisively in play right now. And I'm going to show you now on a 30-day, 1 hour, we're literally just trading from level, okay, back to level. Now, you might ask, well, do you have a level like up here? I don't. Okay. And again, the way I decipher these levels it's a tremendous amount of time in front of the screen, watching volume against price all the way down to a 1-minute chart. And you can see when I say we're just bouncing from level to level, quite definitively, here we are, okay, trading at the 75. All right. We bounced back up. And again, I don't even have this drawn all the way across the screen, but you can actually see this level of the 2626 in play. And this is all the way back in what? You know, the February kind of time frame over here. Then we actually bounced, stopped dead, all right, right here at 2682, did it a number of times. We crossed back through it, stopped at 2682. We got back to the 26 level, all right, and here we are once again, kind of dead between two major levels inside of the S&Ps. Now, my inclination and my feeling, I wouldn't be surprised at all if we went right back up to 2682. So everybody, of course, is going to ask, you know, is that it? Are we out of the dumpster? Are we going to see rally again? The volatility futures at this point in time, as I said, I wanted to talk about vol futures. At this point in time, the volatility futures are still very much in, okay, a backwardation. That doesn't necessarily mean that the marketplace cannot rally. Of course it can rally today. But anytime we see a little bit of a backwardation, and that is the 23-day, okay, volatility futures are still exceeding the 51-day volatility futures, which are exceeding the 86-day volatility futures. What that means is the risk is prevalent in the here and now, all right? So literally the volatility is higher in the next 23 days than it is in 86 days, which almost makes, again, no sense because you're like, well, what does that mean? It means the world is more likely to blow up in the next 23 days than it is in the next 86 days, which is always hard for people to comprehend, including me. But if you take a look at this, the 23-day versus like the 86-day, all right, there's a full point differential, all right? So instead of volatility being in contango, which looks like this, we're in backwardation, which looks like this, okay? So the volatility futures, what do they point to? Risk, and risk is still here. Next down the list, told you we got to cover a lot tonight. Bonds. You got to look at the bonds. The bonds, okay, unusually quiet today. Unusually quiet in what is a big bounce day, which I have to tell you, that to me kind of tips its hat a little bit and says, hey, you don't trust this rally as far as you can throw it, okay? You don't trust the rally as far as you can throw it because bonds played absolutely no role whatsoever. And it makes sense. If you start looking at the calendar, and go over to a calendar sometime, you start looking at the calendar, you got 4-week bill auctions, you got 52-week bill auctions, you got 5-year note auctions. You're like, I don't really look at those. That's okay. As I told you, though, there's $294 billion up for auction, up for for grabs this week. There's a 7-year note. There's a 2-year, no, it just goes on and on and on through the number, okay, of treasury auctions this week. There's another 3-month, a 6-month. All right. If it ain't nailed down right now, the treasury happens to be selling it. And you got to wonder with some of the trade talks that are going on in China, not every sovereignty is all that happy right now with the United States. Are other sovereignties not going to step up and buy our bonds, which that could create risk this week? And you better believe, I think that's one of the reasons the volatility futures are still kind of in that inverted stance. So it's a little bit of a warning shot across the bow. Now, here is again, the big $1 million question. Do I short the rally? Okay, we have a couple things going for us and a couple things going against us. As of right now, if we take a look at the Nasdaq, right, and in this example, let's cruise over to the Qs. So we're going to cruise over the Qs. I'm going to close up the left side bar, and I just want you to look on a year-to-date percentage. Why am I bringing up a year-to-date percentage? Just take a quick look. All right, the Nasdaq, and it was, again, I mean, listen, we're only going back here like 2 weeks. The Nasdaq 2 weeks ago was up what? That's 10%. All right, so the Nasdaq just 2 weeks ago was up 10% on a year-to-date basis. All right, it slips hard and is basically unchanged in the year. So you see pretty much a 10% decline inside of the Nasdaq. To see a bounce over here, I mean, what did you think was going to happen? Did you think we're just going to head straight down? To see a little bit more of a follow through, in these, I'll call it for right now, a bit of a bearish bounce. And these kind of bearish bounces, it's natural to see us actually get back at least half of the sell side activity. So for the marketplace, again, specifically in the Qs, kind of zoom in now for a moment. For the marketplace to sell off like this, okay, no problem. To see us come all the way back up, for example, to like 168 on the Qs would not be surprising in the least bit. In addition to it, okay, you have to realize, check out the date. March 26th, right towards the end of the first quarter. So for those of you that know what a little bit of window dressing is, all right, those stocks that performed extraordinarily well tend to perform a little bit better towards the end of the quarter. Makes sense that they're actually pumping more capital into Amazon right now, all right, up 4%. Meanwhile, Facebook, okay, is a little bit of the opposite in there. So you have a couple of things going for you this week, couple of bullish ideas going for you this week. However, if we continue to see this heavy buy side in the next day or two, yeah, I am going to step in and start to short the rally. And I'm going to do it in a number of products, including the Amazon, all right, including something, well, for example, Google. Why am I picking on Google, which is up $27 today, 2.68%? Because Google has absolutely been slaughtered. This looks like just kind of a routine bounce on the way down over here. I've also got eyes on emerging markets, the EEM, which saw a pretty stellar bounce of about 3.25% today. If EEM gets back up to the 49 level, I'm going to look to place, again, a short position in there. People, this is a trader's market, okay? This is a trader's market, and this is what you've got to do. You got to step up. If you're going to trade this thing, you got to step up, got to short the rally. You've got to realize that the Nasdaq just dropped almost 10% straight down. To see a bounce back to the upside of 3% is absolutely, it's nothing, okay? And that's what traders are really made of, and that's why this is such an opportunistic market. And for one final word here in tonight's evening video, the Return to the Trader live event here in Scottsdale, Arizona in May. We need to know if you're going to be attending. We are running not only out of seats, but we're actually running out of some of the hotel rooms. If you have any inclination whatsoever of attending this event, okay, go to TheoTrade.com/live. But you must email us at support@TheoTrade.com. Again, that's support@TheoTrade.com. Again, we're running out of seats for the event. We're running out of rooms. In fact, the rooms that are being held for this event, those rooms will be released as of April 1st by the hotel. Again, it's a Return to the Trader live event. We've gone through it numbers of times. May 3rd through the 5th right here in Scottsdale, Arizona. It is imperative that you email us immediately at support@TheoTrade.com. Even if you have an inkling of wanting to come to this event, please do email us immediately. Thanks, everybody, and have a wonderful evening. Bye-bye.